Good morning. There's the opening bell. And not that that matters for the futures market, but welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend, Michael Fairborn, out there in the chat, who I very much appreciate taking this class the last couple of weeks as I've been traveling and doing a couple of other things. So I appreciate his stepping in and helping out there. I'm glad to have all of you here with me this morning. We're going to get into things right away. A little bit of backwardation going on in the crude oil market and some moves happening in virtual currency futures is where I was going. And we're going to check out what might be going on in interest rate futures, given the fact that the Fed is back to being, well, we're now back into a potential political situation with the Fed. So let's take a look at what that looks like here really quickly. But before we do that, a couple of quick housekeeping items. Remember that everything we talked about simply for illustrative and educational purposes only, not any kind of a recommendation. Remember that futures and futures options trading involves substantial risk. Not suitable for all investors. Make sure that you're aware of the risk disclosure statement for futures and options, and you read that prior to trading and considering any futures trading strategies. Remember also that futures margin is a little bit different than equity margin. Make sure you understand that. We'll talk a little bit about some of those circumstances as we get into this discussion this morning. I'll also show you where you can find more information about that. Remember also that virtual currency derivatives, including the ones that we're going to look at this morning, involve unique and significant risks. Make sure that you read the NFA Investor Advisory Futures on Virtual Currencies, including Bitcoin, and the CFTC Customer Advisory, Understanding the Risk of Virtual Currency Trading. Remember that they trade as a digital representation of value that functions as a medium of exchange, fiat, store of value, no legal tender status. So be aware of that. Now, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version this morning. Remember that it's a great learning environment, but it doesn't guarantee the future success of any trade or account. And there are some differences between paper trading and live trading. We'll point those out as we get into those discussions. We're going to use technical analysis this morning. It's theoretical in nature, as is any form of analysis. Schwab doesn't recommend the use of technical analysis as the sole means of investment research. Finally, we want to talk about this, and I mentioned this last week. I've mentioned this, or a couple of weeks ago, we've talked about this numerous times. But remember that stop orders, when we talk about futures markets, stop orders and stop limit orders are a little bit different. Stop orders in the futures market are not guaranteed in execution due to exchange rules. Those stop market orders will be substituted for an exchange designated limit order based on protection points. And there is the potential that that order may not get filled, whereas in an equity situation, a stop market order is going to get filled at the next available price. So in a fast-moving market, there's the potential for both a stop market order, which gets turned into an exchange designated limit order, or a stop limit order to not get filled if the price gaps around or moves around the limit price or that range. So those are some things that we need to pay attention to as we get into this discussion this morning. I'm going to pop right over here to the Thinkorswim desktop software platform. We're going to take a look at micro Ethernet or Ethereum futures. Ethernet tells you what I've been doing over the last few days is rewiring some of my network wiring here in the house. I'm thinking Ethernet, it is Ethereum. Micro Ethereum futures as one of the cryptocurrency futures products that we've looked at before. The grid that I'm using here is the Futures Movers grid, which is linked in the description of this webcast. So if you want this grid, you can grab that link there. But on the left-hand side is our one-year daily chart. On the right-hand side is the 5-day, 5-minute chart. Now, I took this trade as an example trade, an illustrative example trade, a little bit earlier this morning. I set it up and I labeled it so that we can see it and we could talk through it. But I wanted to show you the trend of the Ethereum futures, or the micro Ethereum futures. This is the smaller contract /ETH is the larger contract, but you can see the trend. We've talked about this trend before. Since that April low, Ethereum has been moving higher. Over the last couple of weeks, we've seen this rally up, a little bit of a pullback, and then the rally and kind of this consolidation into a little bit of a cobra pattern or a consolidation pattern. We took a trade back here. I've labeled it. Now we're looking at this trade again, and I've kind of got those labels put on here. But I wanted to go through the characteristics of this contract first. The tick size is 0.5, which means that this is our significant digit, the one that I'm pointing to right here. This one right here. Let me see if I can change that. 5.03.0. That 0 is going to move to 0.5 or to 0. Those are going to be the two digits that you're going to see there as this changes, because the tick size is 0.5. So this is only going to be a 0 or a 5 in that significant digit position. That tick value, every time that ticks, is 5 cents. So a point value, when this moves from 4507 to 4508 or 4506, that point value is going to be 10 cents. The risk or the notional value in this contract is $451.10, which is this point value times this number right here, gives us our notional value of the contract. We've talked about that characteristic and how we can calculate that and how we look at those numbers and what that means. That helps to determine initial margin in a position. It also helps to determine the maintenance margin. But if we wanted to know what the initial margin is in a position, to initiate a position here in /MET, we can click on that little drop down arrow. We can go to the futures sub-tab there. We can come down here and we can see that in this case, again, there's our specifications. 0.5 is our tick size, tick value is 0.05, and our initial margin in a position is $154. Now, the reason in this particular account and the reason I'm using /MET, which is going to trade from a standpoint of correlation to the larger contract very, very closely. This is simply the smaller contract, but it is going to have its own forces because it may move slightly differently than /ETH, which is the large contract, which may move differently eventually from the spot coin price. So let's take a look. Let's roll back up here to /ETH, and you can see the differences in the characteristics here. 0.5, still the same tick size. The tick value is now not 5 cents, but $25. And the initial margin is $77,000. Big difference in terms of capital efficiency in an account between $77,000 of initial margin that has to be put up on a trade versus $154 for that. Where's our micro ETH? There it is right there. $154 for that maintenance margin or for that initial margin in that trade. So that being said, that's the reason why I'm demonstrating with this particular symbol /MET versus the other. Now let's pop over here to the right-hand side. I just shifted over to the next grid or the next chart in this grid, which is a today 5-minute chart. And what got me thinking about this and looking at this early this morning, since I tend to get up in the middle of the night and look at futures contracts. How many of you do that? Do any of you do that as well? But I started to see this channel developing in this sideways move in /MET, knowing that there was a little bit of volatility in Bitcoin in the last couple of days, a little bit of volatility in Ethereum in the last couple of days in the spot price, but started to see this channel developing, looking for a potential breakout above this channel top, that resistance level here at about the 44.65 range. Saw that breakout as I was starting to get ready for this class and thinking, and I actually asked this question in my head: is this a rally that gets faded, meaning we sell against kind of that rally, or that rally that moved up, sell against that and trade this to the downside, meaning shorting the contract or going short a position in this particular case, and trading that fade to the downside as that rally faded and then it moved, or lean into a long position on the back of the fact that it broke that resistance level, it made that symmetrical move. So what I did is I duplicated this channel. So I drew this line in as a channel line down here, and you can see that I've got that labeled as a channel. If I activate that, you can see what that channel looks like. There's that channel. The red portion of that line in the middle is the midpoint of the channel, which oftentimes, we've talked about Fibonacci's, we've talked about levels of support and resistance, we've talked about symmetrical moves. Using a channel line like this is oftentimes a way to break a range down, and kind of going along with Dow theory, use that idea that the 50% level of a channel is often a level of support or resistance. In this case, it's acting as such, or it did act as such, potentially as a level of resistance. And then I took that channel and I just duplicated that channel. So I right-clicked, duplicate, and then I took that channel and I just put it up on top, and then I put another one up on top. And the reason for that, let me delete that one that I just put out here. The reason for doing that is, again, that symmetrical move. So we see it rally out to the top of that duplicated channel. It pulls back into this range, and where I actually ended up looking at taking the trade was on this move right here. Let me zoom in a little bit more. This breakout back above the midpoint of that channel that I put up on top. And then my idea was, well, if it's going to break up through that range and it tops out at the top of that channel, then I'm going to duplicate that channel up above once again. So I've got 3 channels here. 1, 2, and 3. The third channel is really simply kind of a 2 times that move of this lower channel, if you think about it that way, because I'm just taking symmetrical even distances and I'm doubling them as I put these up on top. So the way that I set the trade up was a buy stop above 44.95. So once this broke above that 44.95, the entry happened to go long in this position. And I put a stop as an OCO bracket. You can see that this is an OCO bracket because there's that little chain link here on the right-hand side showing these 2 orders. So the OCO bracket, the bottom side of the OCO bracket is a stop, and this is a stop market, which would get then generated as an exchange designated limit order. That stop market order is at 44.65, and my target order, the order to take this off if it goes up, is a limit order right up here at the 44. I think I put it in at 45.80. So you can see visually the representation of how this trade is set up and how it's put together. And in this particular case, so looking for that short upward movement in the context of the longer term trend. Now it's starting to fade as the day wears into the first few minutes here. This is starting to fade a little bit as the cash market gets up and running. Not that that necessarily terribly impacts this particular position. And if we go back, and I think Mighty Mouse asks a great question, which is, when does this AUG25 contract expire? So let's go to the monitor, or actually the trade tab. Let's go /MET, and let's see when that contract is expiring. 3 days left. So we're probably right now in the middle of some rolling activities as we start to see the volume still here in the AUG contract, the current contract or active contract, starting to roll volume-wise into the September expiration contract. The intent of this particular trade, however, is not to be in this trade longer than perhaps today. Now, I put these orders in as good till canceled in the event that this lasts a little bit longer and it kind of turns sideways. But the intent of this particular trade is a shorter term trade So that's still the activity is still the greater volume still in the forward slash in the in this one, which is the Q contract, right? Okay, so now as we look at this, that's the intent and idea behind this trade. Again, not a recommendation. So getting stopped out. So from a risk to reward perspective, just looking at this visually, and that's one of the reasons why I like the ability to put these orders on the chart, is to be able to see. So if my entry was here and my stop was here, that's my potential loss in the trade. If my entry was here and my exit was here, that's my potential gain in the trade if it goes in my direction. So I can visually see this particular trade kind of setting itself up. If we were a day or so from now, Mighty Mouse, yeah, I would say that that would probably be the case. To answer that question, should we go to the U contract? But the current active contract is still this one, and the intent of the trade is shorter term. So still sticking with what is the active contract in this particular case, because it is still getting the activity and the trading pressure. So that's kind of how we set that that particular trade up. Now, a couple of other things. That's our kind of initial out of the gate short-term trade. I wanted to get it set up and put on prior so that we didn't spend all the time talking through it and then missing it entirely. So as we look at that potential. Now, I wanted to look at a couple of other things as we get into this discussion. So let's pop back to this chart, and I'm going to make this, let's go back right here. Let's restore those cells. So I wanted to look at one other thing in this particular case. Let me kill my annotation. And that is, whoops, there it goes. All right. So I wanted to look at crude oil. And crude oil /CL has had a little bit of volatility to it in the last 2 or 3 months. If we look in the left-hand side here, let's maximize that. We drew these Fibonacci lines a couple of weeks ago, and we were looking for that downward move. It kind of has coalesced right here, just about the $65 mark, which is right about the 61.8 Fibonacci retracement, if we're looking at this being the 0 and this being the 100. If we were to flip this over, which is my preferred way, unfortunately for some, I'm going to remove that one. I do my Fibonacci's a little bit differently. I draw from the top of the move down to the bottom of the move, because I want the bottom of that move to be 0%. I want the top of the move to be 100%. And that way I can see those pullbacks and how deeply those pullbacks have impacted relative to that range. So we see that the crude oil contract pulled back into that 50% level, pulled back all the way to 38.2, found a little bit of support right there about the 64, 65 range, pulled below that level, rallied up, and is now sitting on that level at that 38.2 Fibonacci. That doesn't tell the whole story, because there's something going on in the shorter term, which we're going to look at here in just a minute. But I talked a couple of weeks ago about the idea that the 64, 65 range right here is significant. Between 65 and about 68, 67, $68. What do you notice about this contract in terms of, whoops, that's Fibonacci still. What do you notice about this contract that is significant between about 64 and 67, 66, 67, kind of somewhere in that range? What do you notice? Pretty significant level of support right around that range. When it gets below there, that acts as resistance. When it gets above it, it tends to act as support. That range, that $64 to $68 range, depending on the technology used, depending on the field that's being drilled, depending on the conditions, and it looks like 44.60. We got out on the stop. So on our /MET, that's okay. Nothing wrong with that. We know that that happens sometimes, and that's why we put stop orders in place that filled relatively quickly. we're out of that trade. We'll come back and revisit that in a second. But depending on the conditions, depending on the field, depending on the technology, lifting costs, the costs for oil production, exploration, and production companies to pull oil out of the ground, crude oil out of the ground, is somewhere around that $64, $65, $66 a barrel range. That tends to act as kind of a fundamental floor to crude oil prices. Below that, if crude oil is selling significantly below, like it did back here in April, May, if crude oil is selling significantly below that lifting cost, then the E&P companies, the exploration and production companies, are losing money on pulling oil out of the ground. So guess what they do? They stop production or they slow production because it doesn't make sense to pull oil out of the ground when it is cheaper, trading cheaper than it costs them to pull it out of the ground. They leave it in underground storage, as it were. When it starts to move above that level, they increase that production, and then that's, they shift to, because they've got refinery schedules that they've got to meet in terms of deliveries, so they'll shift to cheaper imports. They'll shift to already pulled out of the ground, which is a sunk cost, stored oil, floating storage, those types of things to supply those refinery contracts. But not getting too deep into that particular aspect of it, the idea is that this area tends to act as a support and resistance. It doesn't always have to. It doesn't mean that it can't move below it. It doesn't mean that it has to bounce off of it. But it certainly seems to be kind of landing back on it again today. If we shift to the other grid that we've got, this is what I happened to notice this morning as we were starting to see this build, is this little bit of an inverted head and shoulders type of pattern building on the crude oil contract, right? So underneath that range, and we're kind of right here at about that $63, $76 a barrel range. And this certainly seems as if it may be a bit of a reversal pattern. So sell off, rally up, sell off down to that low, rally up, right hand shoulder, and then it breaks out. So kind of a lumpy inverted head and shoulders. Momentum is never really backed off. And that's what kind of attracted me to this from a technician's standpoint, is momentum. As this was making new lows, look at what momentum was doing. The MACD here was staying above the zero line. It was having a hard time getting pushed below that zero line, which is ultimately an indication that this inverted head and shoulders was kind of resolving some of that selling pressure that was going on, and now maybe starting to see a little bit more bullishness in the short term. The fact that it's sitting down here right around this 63, 64 tends to also suggest a little bit of bullishness in the short term in terms of that crude price. So if we go back to the left to our 1 year daily chart, this is the /CL contract. This is the big contract. Notional value is $63,910. Point value is $1,000. Tick value is $10. And the tick size is 0.01. So our significant digit is this one right here, the 63.89. It's the 9. That's going to move in one increment levels, right? So it's going to go 8 to 9, 8 to 7, not in 0 to 5 like the micro Ethereum that we looked at before. So you're going to see that move. So what we could do, is RTR is pointing out, is we could change this, because this notional value, and if we look at the crude oil contract, our initial margin in this particular case is $6,039. We could move this to /MCL, which we've looked at before, and we've traded. This is the micro contract. And again, now our tick size, same tick size, right? Same calculation here. Tick value, on the other hand, is $1. Point value is $100. The notional value is 1/10 the large contract. And our initial margin for /MCL is $606, which is significantly less than $6,000. In fact, it's 1/10 of that. So the capital efficiency, obviously, when we talk about capital efficiency, I'm simply looking at it from the perspective of how much of a portfolio we might allocate into a particular position. A little bit easier to allocate $600 of a portfolio into a position than 6,000 or 66,000 or 77,000 as was on the large Ethereum contract. So that's what I'm looking at from that particular perspective and saying, hey, we're going to look at positions that are a little bit easier to swallow within the size of a portfolio. Even a large portfolio, to have an initial margin and then a maintenance margin, which is a little bit less than that, of $6,000 or $66,000 or $77,000 is, it ties up a lot more capital. The gains may not be proportionate, however. That being said, to that margin relative to the gains of the smaller contracts. So it's just a matter of what the objective is in the portfolio. So keeping that in mind. Trader is free to trade whatever contract that their portfolio size allows, I suppose. But just talking about it from this particular perspective and not being in any way, shape, or form a recommendation about the size of a contract that you should trade or the type of portfolio allocation that you should take. I don't do that. We have financial consultants that talk through those questions and conversations with clients all the time. But that's not what we're talking about here. We're just talking about that kind of capital efficiency from that standpoint. So thinking through this process. So we're going to use the /MCL, the micro crude oil futures in this particular case. And we're going to look at this trade here as we kind of put this together. I'm going to zoom back out just a little bit. And it's broken. If this is our resistance in that inverted head and shoulders, what we could also do is we could look at this from that standpoint of the channels that we drew earlier. So I'm going to right click and I'm going to redraw that line as a channel. And then I'm going to right click on that and I'm going to edit the properties and I'm going to put in that midpoint of the channel. I'm going to make it a little bit larger and I'm going to make it a dashed line so that we know that that's the midpoint of the channel. And I'm going to save that as the default. We're going to click on OK. There's the midpoint of our channel, which is, in this particular case, kind of acting as the middle of this range, kind of as a support level. It was a resistance level here on the top and pulling back. So what I'm going to do is I'm going to take that channel, I'm going to duplicate it, and I'm going to put it up here, right on top of that channel. And we'd kind of topped out at the top of that channel and run into resistance. Not at all unexpected. And you happen to notice, if I were to continue this over to the left-hand side, notice that that channel top is occurring kind of right about at a level of support. So what I'm going to do is I'm now going to take that channel again and I'm going to duplicate this to the upside one more time and see where we've got a level of resistance that this might run into as we're looking at this trade. And so notice that, that's running into a resistance level as well on that move to the upside. And we can keep going like this, right? We can keep putting those channels. We've talked about this, the tendency for markets to move, not only equities, but also futures markets to move in symmetrical ranges. And so we're kind of seeing that playing itself out here. So looking at the possibility of maybe going long with this strong momentum to the upside. So what we may do in putting this trade together is, I'm going to zoom in just a little bit here. Now that we've seen the context, I'm going to zoom in and we're going to put a trade in, which is going to be a buy stop at the top of this portion of the channel, that kind of confluence between those two channels, a target up here at 64 and a stop below this midpoint line at 63.85. So that's how we're going to put this trade together. So right click, buy custom with OCO bracket. So we're going to make this a buy stop order. And let me close that up so that we got a little bit more room to see here. We're going to make this a buy stop order at 63.92 or 63.93. It's currently trading at 63.88. I'm going to make that a buy stop. Now remember, a buy stop, which issues a market order, is going to do the same thing. That's going to create an exchange designated limit order that's going to get worked. So we could specify a limit at which we don't want to go long on this position. So we're going to make this a buy stop limit that says, fine, trigger that entry at 63.93. But if it's above, if it moves out to 64, I don't want to get in because it's too close to that target. So we're going to make this buy stop limit. 63.93 is the trigger, 64 is the limit price to get in. So it'll fill somewhere in this range if that price moves to that range, or it'll move around that and we won't get filled, which is a possibility. In this case, a small possibility, but still a possibility. And then we're going to put our target out here at 64. I'm going to go to 64.10. So we're going to put our target here at 64.10. This is going to be a short-term trade theoretically. And we're going to put that out as a target and good till canceled. We're going to put our stop down here at 63.85. 63.85 stop, good till canceled. Remember, that's going to be a exchange designated limit order, not as that stop is a stop market. Now we can do the same thing. We can make that a stop limit and define that range, but let's go ahead and click on confirm and send, read through the order, make sure that that's what we want to do. Here's our buying power effect, which is the same in this case as initial margin in the trade. I'm going to put this in my futures group, and we're going to send that order off, and you can see that trade, and it just got filled as this made the move. Fortunately, I didn't talk through it, and it made that move to the upside, and it's making that move. Now, Hans asks the question, does initial margin vary from person to person, depending on account size, or is it different between paper trading and real trading? Those initial margins are going to depend on, in many cases, the account and the characteristics of that account. So my suggestion is to talk to the futures desk about the margin requirements and the margin considerations in your particular account, in your specific circumstance. Now, I'm going to do this really quick. We're going to pop right over here to Schwab.com. So this is Schwab.com. This is logged into Schwab.com on this paper trading account. And you can go to the trade tab here and you can select futures. Once you do that, once you select futures, you're going to see some information here that gives you the market overview, and it gives you that heat map. Now, this is showing crude oil futures. Remember, these little bars are going to update. You can see when the last update was. And the overall change from the past update, which was the previous day, is down. So we're seeing some red in those update bars. We're seeing some green in the index futures, meaning Russell. Some of the metals are moving a little bit stronger here. Currencies are relatively flat. The agricultural futures, wheat, live cattle moving higher, lean hogs moving a little bit higher here. But that's one way to see that information. But the other thing to think about, if you have questions regarding things like margin, regarding things like maintenance margin versus initial margin, come over here to the Learn tab and come over here to the left-hand side where it says Futures and click on Futures, and you're going to get some information. So FAQs about futures, you're going to see information on futures, trading futures for beginners, a great video. You're going to see me and a couple of the webcasts that we've talked about and done. Fundamentals of future trading. Discussion of tick size and notional value and all of those things. So some great resources right here to help you learn a little bit more about the futures market. The other place that I'm going to suggest that you go is right here to the Trader Talks webcast page. And this is a good reminder for me to remind you to click on subscribe while you're right here if you've not done so already. And just type in here the word futures, and you're going to get the playlists. You're going to get the webcasts that talk about futures. So you're going to get some great information here, and a good place to get that additional information. Now, I'm just going to say this too. I'm going to go right here to Schwab Coaching, and this is schwab.com/coaching. I'm going to come over here to in-person events, and coming up, and it's a little ways away, but coming up in Miami in December. What better place to be in December than South Florida? But Miami, gorgeous location. We're going to be at the JW Marriott Turnberry. But in this advanced options strategies workshop that we're doing there in Miami in December, part of that day will be an introduction to futures discussion. So we're going to spend about a quarter of the time in that workshop talking about futures, an introduction to futures, trading futures, and so forth. So that's part of the agenda for that particular discussion. So if you want to come and see us live, come and join us there. We've also got a bunch of other live events that are coming up. This one I think is full. The Washington, D.C. event is full, but we'd love to see you in Dallas at our Market Drive event. We'd love to see you in Chicago at our Market Drive event. We'd love to see you in Orlando at our Technical Analysis and Option Strategies workshop. All right. So let's pop back over here. Still moving in our favor, still doing what we want it to do, at least at this point. Now, one other thing I wanted to talk about crude oil for just a second here, and I want to go back to our /CL contract, the longer term or the larger contract. Is I want to go to our product depth, and I wanted to talk about this idea right here. I had set this up earlier. This is what's referred to as a forward curve or futures curve. So each one of these points represents a delivery date or a contract expiration date. And you can add those into this mix. So here's where I am. I'm in the charts tab under product depth, and I selected futures. Now you can do other things in this particular product depth tool, and it's an underappreciated tool. If you want to learn more about it, you can jump into, again, those webcasts that talk about it. But you can show the different curves. If I were to show all of the series, you can see all of the different expiration or delivery dates going out, actually 10 years and a little bit more into the future, right? Well, because they're futures. But that's kind of really getting way out there, and a lot can happen. So I've gone out really to the April of 2026 delivery date. And you notice what's happening. This is representing the price. Each one of these plots represents the price of that contract at the moment for that delivery. Now remember, the idea behind futures is that it allows market participants to speculate or hedge based on what they expect the future conditions to be. Thus the name futures, right? So if this is the case, this says that the spot futures price right now, 64.03. The next deliverable date, 63.54. The next deliverable date after that, 63.15, and so on, 62.91, 62.73, 62.65, 62.59. So what this expects is the idea that front month, or this prompt delivery, the one that's most recent, is higher than the futures contracts for later months. That's kind of an inversion of the normal curve that we see, because remember, the expectation is there's going to be greater volatility, maybe greater demand out in the future. What this suggests is a potential supply constraint. This is very typical. This is what's referred to as a backwardated curve. And it is typical of a market condition where the market considers or expects future supply constraints. This is also a curve that is driven by market participants rather than speculators. And from the reason I say that is those market participants, the refineries and others, that have an idea that maybe there are going to be supply constraints out in the future are locking in or willing to lock in price now by buying this prompt delivery contract and less certain about what supply and or demand are going to be out in the future. Less expectation. If this were the normal curve, and the normal curve would look something like this, would be a contangoed curve, which would look something like this. That's a contangoed curve. This is a backwardated curve, the one that we're seeing. Backwardated curves typically are bullish, generally, a little bit. But there are some implications here that may not be quite so bullish. Bullish in the near term, maybe from these two deliveries or these two deliveries, but out here, maybe not so bullish. Now, speculators may look at trading or arbitraging the difference between these contracts, selling this one and buying this one to take advantage of that disparity between those two prices, right? If you could sell the futures contract here at 64 and buy one at 63, that's a little bit cheaper, and have that price go up, now you start to see that relationship here from the speculative standpoint. But this is typical, like I said, of a supply constraint. So something to talk about, something to think about. We'll talk more about this as we get into these contracts in future in forward classes. But I wanted to talk about that. That may be one of the reasons, this strong contango between the prompt delivery and the next delivery may be one of the reasons why that supply constraint is here. We're seeing that potential for that move to the upside. So we're still long in this particular case, still looking at this moving to the upside and continuing to move in that particular direction. Wiley asks the question, what's the TED spread? The TED spread is generally the difference between, and I will go a little bit deeper into that in a future class, but the TED spread is generally the difference between the 10s and the 2s. The 10-year interest rate and the 2-year interest rate. So if we come back up here and we take a look at those interest rates, futures, there we go. There's the 5-year. Here's the 2s. /ZT is the 2-year, and /10 is Z. Is it ZN? Yeah, /ZN. So the difference between these two, ZT and ZN, the futures contracts, makes up the TED spread. All right, so that's taking a look at that really quickly here. And as we wrap this up, let's kind of come back over here and let's take a look at the monitor tab and see where we are. Here's our working order that is still in place. So we're in that contract long. Let's look at our group here, and that is our futures group. So MET, we got kicked out. MCL, we are still in the trade. It is still working in our favor, and we just sold it on our stop. So that trade, that went to where we wanted it to go, which was to the upside. So we made a little bit on the trade. We were into that trade, and we were out of that trade. Next week, when we come back, we'll talk a little bit about hedging activities using futures contracts. But I just wanted to kind of spend a little bit of time today talking about how we set those trades up. Taking a look at these trades /MCL and how we put that trade together, and it did what we expected it to do. That one did /MET, didn't do what we expected it to do, sitting right back down against that stop once again. We got kicked out of it, rallied back up. So maybe a little bit of bearishness here in the short term in /MET in the Ethereum futures. So we'll see how that works. All right, do me a favor, guys, if you wouldn't mind, click on that subscribe button if you haven't done so already. Click on like if you happen to like this webcast today. If you're watching this in the recorded version, leave comments in the comment section. Thank you all for being here. My thanks to Michael Fairborn for helping out with this today as well. We've got a whole slate of stuff. I'm going to be back later today teaching long options, that webcast later today. Michael Fairborn's got a couple of webcasts today as well. So we will see all of you again later today as well as the rest of this week. Have a great week, everybody. Take care. Bye-bye.